Hello, and welcome everyone to include donor-advised funds in impact investing, a toolkit for community foundations, brought to you by the Council on Foundations, the Rockefeller Foundation, the Greater Cincinnati Foundation, and Imprint Capital. I am Jeannie Helfer, Manager of Community Foundation Services at the Council on Foundations, and have the pleasure of introducing and moderating today's program. Before we begin, let me share a few housekeeping tools to help you navigate around WebEx. You should receive a cheat sheet that explains these features. In the split screen allows you to see the presentation and use interactive tools in the panels on the right-hand side of the screen. To expand and collapse the panel, click on the top left of the menu bar and toggle the black triangle. Right now, everyone should collapse the chat panel. That feature has been disabled and we won't be using it. All participants are mute throughout the call, but that does not mean we don't want to hear from you. To ask questions of the speakers, type your text in the Q&A panel and be sure to use the drop-down to select all panelists. Feel free to submit your questions throughout the webinar as we will monitor them and seek to address as many as we can. If you leave the call or get disconnected, please hang up and close out the WebEx completely and follow instructions you used originally to rejoin the discussion. This call is being recorded in its entirety. The play link will be sent to you and will be available to the field through the Council's website. At this time, I would like to introduce you to our two speakers, Kathy Schmidt, President and CEO at the Greater Cincinnati Foundation, and Taylor Jordan, co-founder and managing director at Imprint Capital. Kathy, please take it from here to introduce us to the benefit of how this work came to be.
Good, everybody. I'm delighted to be able to spend a little bit of time with you to tell you about using donor funds as well as discretionary assets for impact investing. Before we get started on the webinar, though, I wanted to lay just a short backgrounder on how we came to undertake this important project that was funded by the Rockefeller Foundation. Just briefly, 2 years ago this time at the Council on Foundations conference in Denver, I had the privilege of listening to Rockefeller Foundation President Judy Roden serving on a panel with others and talking about impact investing. And something that she said during that presentation sparked the idea that perhaps it would be possible as a donor engagement tool for donors and even possibly prospective donors to also include them in our foundation's program of impact investing with our discretionary endowment dollars. I was privileged to actually receive a grant about 6 months later that did two important things. One is it helped the Greater Cincinnati Foundation establish one proof of concept that a group of donors who live in my community thought this could be both an interesting and important idea, one that would be of broad appeal to donors. And the second part of the Rockefeller Foundation project, which is really where this webinar comes in, is that we're able to work with Imprint Capital and other community foundations to sort of fill out the concept of how a donor-advised fund product might work in various communities, because we are not all the same. I think that's an important, you've seen one community foundation, you've seen one community foundation famous line, but in fact it's true. So what we would really like to cover are lessons that we have learned both at the Greater Cincinnati Foundation and at other community foundations on how a program be designed and structured, and how one might approach the task of engaging donors, and then to review with you a toolkit that we've created as a practical leave behind from this Rockefeller Foundation project, and then a couple of closing notes about more activity that we see might be happening in the future. This, in fact, turns out to be an important, exciting topic for many foundations, including community foundations. I do think that we will pause from time to time in our session, and once we finish the lessons learned, we will actually take an official pause and see if there are any questions that we can answer at that point. We will have a second pause right after we have laid out the toolkit elements, and then at the close of the webinar, we'll have one final Q&A session that will be moderated by the council. And with that, I will, I think, carry on with this background. Here we have this slide here. So here is what we set out to do and actually accomplished in this project. The first, we really wanted to create something very, very, very practical for community foundations that we've been calling a toolkit, grounded in the actual practice of community foundations who participated in the development of the toolkit, and be very oriented around their specific programs, their specific experiences, and the actual tools that were used in the process of engaging donors and developing the program. Again, it was very important that we root this in the context of multiple institutions. It turns out that we have that are on the West Coast and one Midwestern, but in fact there were a number of other community foundations throughout the country who were quite interested in this working and taking a good look at it. So we ended up working with 3 community foundations in addition to Cincinnati. This is the third in our series of webinars. There are 2 other webinars, and we will come back to information about how you can access that in just a moment. And the final deliverable for the Rockefeller Project is this comprehensive toolkit. So with that, I am going to turn this over to Taylor Jordan, who's going to walk us through the participants and their experience.
Kathy. So as Kathy mentioned, we had 4 total community foundations participate in the project. I want to thank each of them for taking the time to participate, and each has added tremendous value in terms of the learnings that we're going to share with you today. A great diversity of programs and geographies that they covered. We have a couple of cities, we have a county, and we have a state-level community foundation to integrate in all of the different factors into the learnings that we're going to discuss later today. We've covered both rural and urban communities as well, although I'd say most of this has been focused on more urban communities. Looking at the participant profile, and which has led to a lot of the findings, we have worked with the 4 with $300 million or more in assets. So these are larger community foundations. We, as part of the next phase of this, to work with smaller community foundations and structure something specifically for them that meets their needs. It's been a question that's been asked as part of the previous webinars and presentations in terms of how to do this at a smaller community foundation. We've got a great diversity of experiences in terms of the years that a program has been in place. For over 20 for Marin, to kind of brand new at Arizona, which is to both think through how to market an existing program to new donors or to existing donors at a community foundation to get the program off the ground, either with discretionary funds or directly with donor money to start. Cover this in a little bit, but there's some different program structures. 3 of the 4 use investment pools, essentially commingled opportunities for donors to participate in a portfolio of deals, versus Cincinnati, which is participating at deal by deal with their donors. And there's some pros and cons and advantages and disadvantages to both of those structures, which we'll cover. In terms of execution, both internal, to the extent that the foundation hired a dedicated person in-house to underwrite the deals, or the deals, they have done that, as well as hybrid, where we used external consultants in specific situations to underwrite deals and or manage the program. Started with some high-level lessons learned, and then we'll get more specific as we go along. This is really around getting started. As I mentioned, some of these foundations have had their programs get off the ground within the last 4 years. And so part of this effort was to understand how to launch a program and then engage donors versus taking an existing program and bringing it to donors. The key lessons pretty early on that we discovered is using discretionary funds first makes the most sense. This part because donors respond best to concrete deal examples versus theory or theoretical concepts. Program off the ground with discretionary funds, having those deals in place to then provide to donors is an important step in getting the program off the ground. I think as part of there's a number of administrative and other issues that need to be worked through in setting up a program like that, and doing that with internal funds versus doing that with donor funds is also important. is, don't recreate things or don't recreate the wheel if you don't need to. For foundations, there are established intermediaries in their communities, community development financial institutions being one type of those that you can leverage in getting the program started. It also ties into what we call early wins, which are risky, more liquid, easy to execute transactions, which you get started with, and then you build off of to do more complex transactions as you kind of build some experience in doing this work. In the case of Marin, which is interesting, is they don't have a suite of strong or intermediaries in Marin County, and so they've essentially become an intermediary. So they've created a loan fund to essentially fill that gap. For San Francisco, there's a number of established intermediaries in the community which can be leveraged. And Cincinnati also has a number of intermediaries, but they have gone through those and are now into the more complex direct investments as a result. Here is, really be proactive and intentional about how you build your pipeline of investment opportunities. Because you create the program, it does not mean that quality deal flow will come to you. You have to get out there and find it. The good news is you already have all those relationships and those networks through your ongoing activities as it is. It's a matter of proactively going out and finding it and talking about this in a different way. This is an investment, not a grant. The money needs to come back. And so having those conversations proactively is key. Point is, which I've already highlighted, is this really needs to be grounded in concrete deals. This is really key. We've found this across the board in talking to donors, that being able to kind of get their heads around what this actually means and how this money can go to something that they would support with a grant but is recycled back into their donor fund is the key thing that's going to get them off the fence to actually participate in the program.
To add a little something on that slide, if I may, before you go on to governance, if you could just go back one slide.
Yep.
We're going to talk a little bit more about the vision of how you use intermediaries and build a portfolio of early wins. But I would just like to say to my colleagues that what we found, at least, is that most of the solid intermediaries that exist in our community, and it's our understanding that that is true elsewhere, are in the field of community development. Relatively tried and true organizations that work in affordable housing and neighborhood development. And from our standpoint, those kinds of deals constituted early wins because they have been done so many times in so many places throughout the country for nearly 40 years. But it turns out that if you really get creative, think about building a diverse pipeline of investment opportunities in other sectors, that can actually unfold some fascinating opportunities to really help grow your community. We want to highlight some of those later, but I wanted to say that now just so you could be thinking about what kind of intermediaries and early wins you have in your own community, as well as what other kinds of opportunities might exist. Thanks, Taylor.
Great. Kathy, I think we'll probably jump in on the governance slide as well. And again, thinking about how to structure this in your foundation based on your specific context is key. These are some of the learnings that we pulled out from this experience. The first one is the Impact Investment Committee, if that's what you want to call it, needs to be fully independent and separate from the existing investment committee. Have clear decision-making authority to make investment decisions. And I think what this does is this clearly crystallizes what that committee's role is and ensures that the different goals and objectives of the traditional investment committee are separate. The specific orientation of this program is impact-oriented. There are going to be differences in financial returns and liquidity and some underlying investment characteristics, and it's important for that committee to understand that and make decisions around that. Again, grounded within the overall organizational context. So that's the first point. This is having committee members that have both finance experience and an impact orientation is also quite important. And we've really been impressed by the caliber and inclination of the investment committees we've worked with at these community foundations. These folks that a lot of them are local bankers who have volunteered in the community or are part of a group within the bank that has a orientation. and it's important that that they're included in the process and that they understand what the overall impact objectives of the organization and the program are. But they also bring that finance expertise, and they can ask the hard questions and can help in coming to the right decision. And is having all of this grounded within a really clearly articulated investment policy. And we're going to give an example of an investment policy as part of the toolkit. But this is going to really outline the goals, objectives of the program, and then really the constraints to that you don't take on more risk than you want to, et cetera. And we'll give an example of that as I mentioned.
That even though I do agree totally, these 4 bullet points are generically true as lessons learned across all of our experiences. I would just like to highlight one part experience here in Cincinnati, which is we did not have a separate impact investing committee. We were actually pretty new to the process, and we really tried not to create more committees and spent a fair amount of time fumbling on trying to make this more complex and sophisticated assignment fit within existing committees, and ultimately that really just wasn't working. So I would advise as a time saver to my friends and colleagues that you think immediately and directly about having an impact investment committee whose job is to conduct the due diligence of the deals in your community with an eye toward how you will include donor advisors in that process.
Great. So going to the next slide, this is around program structures, and the 3 main program structures that we've seen in the field and we've seen executed effectively are dedicated impact investment pool. So this would be an investment pool that's not different than your existing investment pools, except obviously with an impact orientation. On a deal-by-deal basis, so donors can participate in individual deals that the foundation underwrites, and this is what the Greater Cincinnati Community Foundation has implemented. The third option is to integrate the impact investments into an existing investment pool. So to start the first one, I think this is the one by most community foundations, and the advantage is it's easy to communicate and market. You need to differentiate it from the other investment pools, but it's relatively easy to explain in terms of how donors participate. I think the disadvantage is it is administratively challenging to manage liquidity for one thing, and how and when donors can get their money out of this pool into their fund to then use for grant making. Given most of the deals we've seen from the community foundations are in organizations, are not liquid, and some real active management that needs to happen around that. Second option, the advantage is clearly there's strong donor engagement. This is the option where they have the most control and they can choose the very specific transactions that they want to participate in based on their interests. The disadvantage is administration and coordination of that is quite complicated in that you have to do that at the individual donor level, and you have to think through what the minimum investment size is that makes sense to do that. Option is the most seamless. You just do impact investments within your existing pool. There's no additional administration or marketing necessarily required. You would set a out of that pool. You would say 5% is going to go to impact investments, and then you go out and you find those investments and then execute them through the existing options. The challenge, however, is that if you're going to have the program focused on your local community, it may be difficult to find more market-oriented investments that meet your pool financial objectives can go into the pool and have it qualify. So we foundations execute all 3 effectively. And going to the next slide, to use one form or another is really grounded in some of the structural considerations that we highlight here. Kind of first and foremost, what are the foundation interest objectives? Are they exclusively interested in doing local funding or broader, going into a national funding through their impact investment pool? If they go broader, they can go option 3 and potentially integrate with investment pools. If they just fund locally, it's harder to do that. I think risk is a really important one. Are you willing to take in the pool? there is sometimes a correlation between risk and impact, and so you have to make that decision on a case-by-case basis. But making the decision in whether you're willing to take significant equity-like risk or whether you're going to keep it to more traditional debt and low-risk fixed income investments is another consideration. And capital do you have for this program? Is it just discretionary? Is it just donor? How much do you have of each of those? Those are also really important considerations in setting up the program. Donor interests, are they general in impact investing? They've heard the term, they're interested in this concept, or are they very specific, where they want to fund specific products or fund within specific issue areas? What are the liquidity needs? How often are they making gifts? How much would they need to pull down that investment to make those gifts? And what are their risk thresholds? How much risk are they willing to take to do this? Would they consider it as a write-off for a grant, or would they really want to ensure that their principal was maintained? Different minimums for participation in a fund. We've seen it as $15,000 plus. We've seen at $75,000, and I think that really is based on who the donors are in your community, how they'd want to participate in a program like this. And then lastly, what back office and administrative capabilities and requirements of each of these programs. How sophisticated are your internal systems, and how much of this can you do yourself versus you need to outsource, and that will also have a major factor in which structure you end up choosing.
I want to continue on with the structural considerations and talk about three that are really sort of particular to the Community Foundation perspective. First of all, parallel to how much money a donor advisor should be allowed to allocate from their donor advised fund or in each deal. I'm sorry, I'm really speaking the sentence. I fumbled a little bit. Sorry about that. Two considerations that you need to take into account is how much money on either percent or an absolute basis the donor advised fund should be allowed to contribute to each fund, and then how much they should be permitted or required to contribute for the deal. So let me give an example of that. It might make it easier. We have set as a policy that no more than 20% of the current asset value of a donor-advised fund should be allowed to be used for impact investing from that fund. And we frankly thought we would be surprised if a donor wanted to even use it for impact investing, and then we found that they were interested in even more. So for donors who find this method of investing appealing, I had one donor say, well, I'd like to invest all of my money in a particular type of deal because we had found their point of passion. In other words, the deal that we were working with is exactly what this donor thought was the most important thing to do in the community. So we actually created a method for policy exceptions, make sure that the donor understood that their fund would be illiquid for that period of time, and that actually works for a donor who may not be an active grant maker at that particular moment. So I advise, based on that experience and a couple more like it, that you have a policy and it be very clear and that you've thought through based on your donors, but you also make provisions for exceptions. And then we look at each deal. So this is now flipping the lens to the other side of the equation. First of all, the foundation makes a decision that we would fund 100% of what we've been asked to support. Then if donors decide that they would like to co-invest side by side with us, the foundation actually reduces the amount of money that it puts from its discretionary fund into that deal, because we've already made a decision on what the number is that we wish to invest. That within each deal there ought to be some parameters of what your total exposure should be in any given deal. So then what we do is we set a minimum investment for that particular situation. Our minimum, regardless, is $10,000, and I'm pretty sure that my finance and administration staff would prefer it was even higher, because it in fact is, as Taylor has already pointed out, a fair amount of back office work to make sure that you've got everything properly set up, that you've done all your foundations, that you've done all the proper due diligence, and that the donor understands the liquidity of that that participation for a period of time. Some deals, for example, an equity fund that we are a part of, has a $50,000 minimum for individuals to participate. And so we decided that we would apply that same minimum participation to an individual donor-advised fund, so that the structure of the whole equity fund would be the same. So look very carefully at what will work for you, because I can't say, and Taylor, I don't know if you would agree with this, I can't say that we came up with a universal rule of thumb that would work for everyone. Only know that you have to ask the question, have to set your own guidelines, and be very clear about that. Would you agree, Taylor?
Yeah, I agree. There is not a universal number here, and it's really based on your context, donors in the foundation.
And again, I can just, my chief financial officer is actually theoretically and metaphorically sitting on my shoulder while I'm saying all of this. How much it costs to actually start up and manage a program like this is not inexpensive. The real permanent source of subsidy, other than resources, and with the exception of the generosity of the Rockefeller Foundation in this particular case, to help with what it takes to start the program. Our hope is that the toolkit that we've created will at least reduce the amount of time and effort that it takes for an individual community foundation to sort through the options and to sort through the considerations and make sure that at the end of that consideration you have created a strong program that has really covered all of the points that it takes to be both successful and good stewards, because that is important. Then the question of fees to cover the cost of the program ongoing comes up once you get it started. And so we have included fees to this point in two ways. One is that we charge a fee to the borrower for any legal costs that pertain just to that deal. Covered any legal costs associated with the program with sources, but on an individual deal, we pass that cost along to the borrower. And then in designing the return structure of each deal, we really have to sort through how much does it cost for the due diligence, the monitoring and the reporting, how does it cost for the back office, how much is that deal likely to generate in return over what period of time, then how much at the end of the analysis would be left to create, in our case, a below market and small financial return to both the foundation itself and to the donor-advised fund. So you have to be able to slice and dice each of those pieces of the program costs and fees. Be clear, if you're going to subsidize them, that it's central to your overall mission. Of course, the consideration of relationship is critical deal by deal. But that's your social mission, and this has to be clear if you're going to spend money out of your operations, which is what we did, that it supports your overall mission as a community foundation. And we have made that decision that we will partially subsidize and partially support through fees the cost of this program. This is really your people and your knowledge of your community and how much capacity each has. So let me take them in turn. In terms of pipeline development, it is both very important and realistic for you to look at very traditional methods of investment, such as community development. And we thought early on that it would not be possible to go beyond that because we did not have any well-established intermediaries. And we were actually provoked by a fellow who worked here at the foundation to education, and we had this enormous aha moment. It was like, you can invest in education using impact investing, and that's to health, and that's to the environment, and that's to minority business accelerator lending, and a number of other things. So it is really important that you have someone or multiple someones on your staff who believe that their job is to help generate a pipeline of investable opportunities over a long period of time. You have to actively seek out opportunities to invest money because in community, most of you will be seen primarily as a grantor, and if your community doesn't know that you're willing to leverage your investment in a new way, then they can't ask you for that. I actually visited with individuals personally. We hosted outreach sessions by sector and really worked hard on stimulating the that people talk to us about their ideas. I think one of the most interesting that we might consider later this year, just as an example, is social development at our Cincinnati Zoo and Botanical Center. And of course, who doesn't love the zoo? And we're quite excited about being able to look at that deal. Make sure to everybody, including people asking you for money, that these are loans or equity investments. They are not grants. And that brings me to the second point from the previous slide, which is about due diligence. I can tell you that I have incredibly capable, very smart staff who work at the Cincinnati Foundation, but we do not have, even if you add everybody together, the type of resident skill set that you need to particularly the financial due diligence. We feel like we are A+++ at social return and not have the time, the skill set to do the diligence review, and that is why we have chosen to continue our work with Imprint Capital, because in working with their company, we have access to, I don't know how many people we've worked with so far, half a dozen at least, who have different skill sets and expertise, and purchase that relationship based on assets under management. So diligence is really critical in thinking about trying to do it yourself or being able to purchase that talent outside your organization. And then the third thing I want to mention as a structural consideration, sort of back to the previous slide, Taylor, if you don't mind. I'm working on that third bullet under structural considerations, is donor marketing. I believe that that is something that you must do inside your organization. At one point early on when we started, we thought, well, maybe that's something that could be outsourced as well. But your staff and perhaps even your volunteers, your board or committees or whatever, are the ones who have that deep personal knowledge of their interest in the community, appetite, frankly, to take on something very different from grant making, like impact investing. I will say, as I have said in previous webinars, that we were pretty surprised about initially who ended up being the most interested in impact investing, but we needed to have a target list of people that we would start with. We actually needed to have our staff sit down with people one-on-one. This is not a group sell. You can do a group information session, but it is not a group sell. So you have to make sure that your people understand your donors well enough to target an opportunity and make a customized pitch to them. So once again, that time and capacity question, these are all important considerations of designing the structure of a donor-advised fund impact investing program. Thanks, Taylor. Staff requirements, so I will carry on with this slide. This doesn't sound unhumble, but I'm pretty sure that if your CEO isn't behind this, you're not going to get this done. This really takes an all-foundation effort. It takes every type of smarts and resource that your community foundation has to offer to make this work, and it's actually what I love about it the most in actually quite lovely ways. It's been an incredible team-building experience for helping them know more deeply what others do in departments that they don't regularly need to interact with. So CEO support and commitment and buy-in is critical from once I said this, but it bears repeating. You must have an internal resource resource for program management and pipeline development. We have one person in our, what we call our community investment team, who does multiple things, but one of the most important things that he does is cultivate a pipeline of investment deals and help guide our potential borrowers through that process, and he is critical to the success of the program. And finance group has to buy in that they are adding duties and complexity to their work. This is not sort of the standard work of a community foundation. Well, part of it is, but part of it is not. And so there's opportunity for professional growth and development in that group, but it's also a capacity question. Do you actually have enough people and enough time to make sure that you can maintain the integrity of stewardship in this program? Integrated marketing and communications is key, especially because we have learned in numerous ways that this is very difficult to communicate, this impact investing notion, especially how donor-advised funds would be engaged. It is difficult to communicate this in non-jargony ways to brand new audiences. And so one of the things I highly commend is, number one, materials that we have developed, which are in the toolkit, and we'll come back in a moment. Use them as you wish. They're a gift. Or change them to suit the way you talk about things and the way you do business in your community, but we've at least given you a head start on that. So you need some paper, you need behind, but you also need to help your staff internally practice the key messages so that they can be good ambassadors to help the opportunity for donors. First, you have to have full integration in your development group, or as we call it, giving strategies. Now, everybody in our giving strategies group is working on this to the same degree, but we have spent a lot of time together talking to donors, talking about donor interest, identifying donors that we think might be interested in specific deals, decide who's going to make the pitch to that donor, and then going through that process. So it's a real development team effort that requires the others in the organization to help think that through. Finally, just to restate, you have choices depending on how the station is, where you live, what other kinds of opportunities exist where you live, to either conduct yourself or consulting basis your due diligence and portfolio management. And again, for us as a medium-large community foundation, we made the choice to outsource that part of our due diligence and portfolio management. I think at this point we will stop and do some Q&A. And Shani, are you going to help us field that?
Absolutely, and I just want to remind everyone, feel free to continue sending your questions in through the Q&A chat box so that we can try to get to as many questions as we possibly can. Our question, folks are talking about real concrete examples of deals that have and have not worked from your experiences through this work.
Do you want to take that one, or do you want me to?
I mean, I think there has not been a lot of significant issues in the deals actually blowing up. So that's the good news. I point to Marin as an example, and since they got founded, they haven't had one default in their portfolio. So it's been tremendous success in having this work as an investment and having the funds repaid. I think where we've seen some challenges is the inability to deploy funds, and we've seen this where you would work with a national intermediary to do targeted investments in the local community, and for a variety of reasons, they've been unable to deploy the full funds and have had to return it to the foundation. So there's one specific example of Enterprise who was a very innovative green retrofit program with their affordable housing programs, and do a combination of with government grant and the rest. They weren't able to deploy the full amount, and so the money was returned. We still view that as a partial success. Clearly, it didn't have the full impact that the nation wanted to achieve, but to seed a pilot that had some impact, and there's a lot of lessons learned kind of through that experience. Kathy, you want to highlight some Cincinnati deals?
I would. Every one of our community development deals has been paid back on time or early. And I just want to use that example to underscore, if you have not yet started an impact investing program, for sure you want to start in this category, because there are community development financial institutions and other types of intermediaries like Enterprise, like LISC, like credit unions. Look in your community, see who you have that you could work with that has a strong track record. You can do mission deposits. There are a million ways that you could work with that existing infrastructure to put your capital to work, increase in low-income communities. Even if it's brand new to you, it's tried through in the universe. There's lots of guidance on how to do that. I'd like to say that on non-community development deals, to be honest with you, I think we're so early in that I'm not sure I can tell you if it's going to work or not work. It looks like it's going to. But another example that I think might go to your core point, what if you want to work with somebody and it's a perfect thing, and for Unity Foundation, but they don't have the capacity to do the work? And I'm going to give you one example. We're almost, I think, through this process. We have a minority business accelerator that was created to help existing minority-owned businesses grow quickly and add jobs to the community. This is the purpose of the minority business accelerator. But what the biggest barrier always is the cap gap and access to that credit. We approached, this is an example of how you proactively cultivate a pipeline. We approached the leadership of the minority business seller with this idea, and at first they were like, no, we do that. We don't make loans. That's not what we do. We have a different kind of program. They're like, okay, we thought you would follow with this. Our feelings were a little bit hurt, but only barely, because in too much longer after that, they came back to us and they said, we are interested in this because it is, in fact, the number one barrier that our clients cite. And so we are working with them to figure out how they can either bring in-house or outsource a lending function. So again, it's the same set of questions, but because we actually have grants that we can pair side by side with loan, we have a grant to help this minority business accelerator build that capacity so they can be good lenders and strong stewards and help minority businesses grow to access the next tranche of capital that's available in the marketplace. So that's an example of yet another way that community foundations, I think, are profoundly well set up to do this kind of work in your local community.
The thing I'd add is one of the earlier webinars we gave 5 or 6 concrete examples of deals, and we'll include that in the toolkit, so you can refer to those. We have also provided a kind of a full list of and descriptions of deals that the participants have done as a way to kind of write it up for donors, and so hopefully that's helpful as you think about and understand the kind of deals that are being done by community foundations. The follow-up question to that was kind of what kind of returns are you seeing from these investments, which is obviously different than if they're up. And typically on the debt side, returns are kind of 1 to 5%, and those are kind of fixed rates back to the foundation. And then on the equity side, it's still too early to tell on the initial deals that we've seen, at least, but they're certainly targeting 10% types of returns.
Next question is, how do you measure performance, and how do you report it back to your donors?
I'll take them. So we have not yet hit the first report period, but we're about to in July. And so we started to work on templates that are not yet in the toolkit, but I promise you, anything we develop heretofore, anybody who wants it can have it. But we really believe that we need to report into the return that has been accumulated to that point and financial situation, because it's unlikely that in the short term financial return will actually be generated. So donors who are in a deal, and you could describe a deal where you get return all along the way, but in deals you don't get return immediately, it gets paid back later. So donors would not actually see that dollar amount in their fund activity statement, but we have created a line, a category, shall we say, in the fund activity statement that a donor can see online at any time and then receives physically from us once a quarter that states the amount of the investment that is illiquid and any financial return that has been received against that loan. So it's a combination of the fund activity statement and a more report of the financial situation, sort of the monitoring and reporting type of thing, as well as the return to that point. And then we're doing briefings from time to time, because part of what we learned from our donors is that they actually like to get together to talk about this. So it's not so much one deal, the deal as a whole. So there's really some community engagement aspects to this that we rather like.
And before we move on, in your outreach, do you specifically go to venture capitalists, private equity, impact investment funds to identify source deals, and what else do you go to other than those?
To answer that question, except for to say that in Cincinnati, while we're learning how to crawl and walk before we run, we've actually gone directly either to intermediaries who exist already or individual nonprofits with whom we have a pre-existing relationship. There are other ways to go about impact investing, and maybe Taylor, you could talk about in the larger universe where you opposite thing, you have a deal that you might invest in. But we are very knowledgeable about the people with whom we will consider doing business. We are knowledgeable because of our grant-making relationship over time before we consider making a loan. So this is we think, risk mitigation strategy in the early stage of our program to do business that way. I hope that's responsive to the question.
Just to follow up on that, I mean, what we're seeing community foundations do is partner with a local intermediary, private equity fund, or venture capital fund, either participate directly in their offering or to co-invest alongside of that organization into a deal where they get value add and the expertise of the intermediary who knows how to underwrite and knows the transaction well, and the intermediary gets a co-investor that knows the community well. And we've seen a variety of approaches, but the thing is, don't limit the you can reach out to, nonprofits, for-profits. You can find deal flow in a lot of different places, even if it's not obvious on the surface.
To the donor engagement piece.
So, first of donor engagement strategies is kind of whether you're marketing an existing program or whether you're co-designing a program with the donors. And Cincinnati had the experience of co-designing with the donors, which led to the ultimate structure of the program based on their feedback. For an existing program, it's more about how you reach donors in a new way, particularly if you've used discretionary funds. And so one of the key things on marketing an existing program is to get a feedback loop from your kind of key donors, and typically these are your larger donors, so they feel like they're part of the process. You're not necessarily opening up the spigot so they can actually design the program, but you're really engaging them so they feel like they're helping to catalyze this new innovative tool that the Community Foundation is developing. You can broadly market to the donor base, which would include smaller donors, and we'll give a lot of examples and feedback on how to do that effectively. In terms of designing with donors, I'm going to let Kathy handle a lot of this, but it's the right focus group and developing demand tests, and we'll give examples of this in the toolkit so you can bring together your key donor groups that will actually help formulate the actual strategy that you're going to execute against. So maybe Kathy, if you want to take that piece on.
Answering a question, so I heard part of what you said. So go over the co-design with donors. Is that what you're?
Yeah, talk about your experience in Cincinnati in the actual co-design of the program with donors.
We decided that we would stage a feasibility process because it was such a brand new idea, and invite a combination of current donors and donors people we thought we'd like to have as donors, to ask them to give us feedback on first the idea and the concept and the program structure, which is how we learned that for our donor community, the one donor, one deal at a time approach was the only thing that was going to work. We learned pretty quickly that idea, which is that donors would contribute into an evergreen fund that the foundation could use to support its work, really go anywhere. Now, I just have to tell some of you, I see that there's a couple of questions about the size of the foundation. It may be possible donors in smaller communities would be trying to help the foundation establish an evergreen investing program, so they would basically make a grant to you at the community foundation that you could use for lending purposes, but that's kind of a custom question in community with your donors and your relationships. We also found, because we did ask a couple of venture capital types to sit down with us, wanted us to set up a structure that would basically operate outside the foundation so that they could participate in deals. And we were like, I don't think so. I mean, I suppose that is possible and legal. In fact, we know it is. But like that was too, if that's the right word, but certainly more sophisticated than we were prepared to move at that time. So we found out fairly easily and quickly the type of program structure that would work for our donors. We also found out from their feedback that they were most concerned, whether they were donors or not, and this was very interesting, that the foundation's trust, respect, and strong track record of stewardship was really its stock and trade, and that we should do absolutely nothing to bar that loose. And so their advice to us on due diligence, on how we would disclose and report to donors, was very in-depth toward protecting our nation and our brand, which I thought was fabulous. Got to the point where we'd kind of sorted through all those programmatic and structural questions. Then it's time to get help with the messaging, because as I said earlier, and just to reiterate, it is really kind of complicated and can be confusing to explain this to donors. We're probably iteration number 10 of trying to scale down to really clean, clear, simple language, and we asked our donors to help us with that feedback as well, and we're happy to do it. So my advice would be ask early and ask often, because if your donors are anything like our donors, they're keen to have a way on a project limited basis to help the community foundation grow.
So moving to marketing, there's the term impact investing, which most of you have probably heard. Actually, a relatively new term that has received a lot of attention in the press and has a lot of money behind it, and has a lot of momentum as a result. So we do recommend branding this as a community foundation innovation in the area of impact investing, with the key differentiator being an additional tool that is similar impacts to grants, except the capital recycles. So while others have their funds with you, they can have impact in their community through these investments while waiting to make the grants. And this needs to be clearly explained vis-a-vis the grants in terms of it recycling back into their fund, which they can then make a grant from. The questions, I don't know if we have a compelling answer on this yet, and I think it will vary case by case, is whether you group get this to donors or do it one-on-one. For the larger, more established donor can make sense, but in other situations, having events that bring donors together is a more compelling way to market the program. So really leading with compelling examples. And this leads back into use discretionary funds to make actual investments to then provide to donors as case studies for the things that they can participate in, versus just talking at a high level about the concept of impact investing. Don't overwhelm them with materials. We've seen this before, and I think it can become overwhelming when you're thinking about becoming either a new donor or your existing donor and getting 5 or 6 different levels of materials. An overview, presentation, or report on what the program is, that's kind of 1 or 2 pages, frequently asked questions, and the list of the deals by the different sectors, and that's a recommendation in terms of the amount of materials to provide. About really focusing on connecting them directly to the investee stores and the investees directly if you can, which would be site visits, which would be bringing the investees into your office to explain what they're doing and how this investment capital was enable them to accomplish their mission, how it is an important additional tool for them to have impact in their community. And then lastly, for certain donors that are very interested in a specific geography or issue area, you can customize their experience by essentially linking their investment to a specific deal, say if it's in a pool, or to a specific community. And this would entail having some internal allocation and reporting and tracking requirements, but we've seen this very effectively used by large intermediaries like the Calvert Foundation and Community Capital Management that actually give donors the sense, or investors the sense of customization, but within a pooled setting. And I can give more details of that in the Q&A session if that's helpful.
One thing, Taylor, and that was to reiterate the one-on-one versus the group marketing question. Our experience, and again, this is just one community foundation, is that it can work to induce the concept in a group setting. We've done that numerous times, both with people we know and we'd like to know, but the closing of the deal just simply won't happen. Nobody is going to walk up to you and say, wow, I think that's the coolest thing, where do I sign? But they give you a heads up that they'd like to hear from you on follow-up, and that you just have to be prepared immediately to pick up on that. So we do any kind of a group presentation, especially if there's new people to pitch to. There's at least one person from our Giving Strategies group, and unless there's a scheduling conflict, our pipeline developer goes, because usually what people want to know about most is the self. That's, you're capturing someone's heart and their head with the idea of recycling the money into their donor advised fund. And I just laugh really hard when people say, is that legal? And the answer is, yes, of course it is. Thanks, Taylor.
Yep. And at outreach, we do recommend having kind of two clear donor segments that you're pursuing. Our donors that are explicitly interested in the impact investing, they're familiar with it, they want to use their donor and the multiple tools available to accomplish their goals. So in this case, you're really selling the general benefits of impact investing, the ability to do more with your philanthropy, the ability to recycle your capital while the fund is sitting at the foundation. You're keeping it at a relatively high level. This type of donor are donors that are less familiar with the concept, but they have very specific mission interests, more about selling the individual deals in the different sectors that you're working in than it is about selling impact investing as an overall concept. Part of this, tying it back to their grant making, is obviously a key first step, and see whether there's overlap both in your focus and the deals that you have in your portfolio to what they're actually giving grants to. And that could be where they've given a grant to a nonprofit that you've also made a loan to, or it could be they've made a grant to an organization within the same sector. And it's about the ability to sell the specific deals and allocate that investment to those deals as part of the pools. And as part of the written materials we're going to provide, we give examples of how to do this, but at both a sector level, where you're talking about your program and affordable housing, for example, and the underlying deals within that, as well as individual write-ups on the deals themselves, talking both about the financial profile and the mission impact. Success stories. Kathy's going to kind of handle the Cincinnati Foundation, but I'm going to start with Marin, an example of a program that's been around for over 20 years, and our work with them was much more around finding ways to engage both their existing donors, but then more importantly, attract new donors into the foundation. They broad interest in this concept of impact investing, and having this as a tool is a means of attracting new donors, we found. And just a quote from someone that has participated in the program and is getting the double bang for your buck, as you will, while the fund sits at the foundation. Kathy?
So, story about our early adopters. We just started, I think it was last September, actually pitch to donor-advised funds because we needed to get enough projects speak in our pipeline that we had some options beyond, including but beyond traditional community development. For whatever reason, that subject is very to philanthropy, and it is less appealing to individual donors, although that's not universally true. So what we found out, much to our surprise, is the people who were the most interested in impact investing were earners over the age of 70. And they must imagine that this is a fountain of youth. If they have a 5 to 7 year return horizon, that they will surely live long enough to see that. But we really thought that the people who would be most interested would be much younger than that. And what we found when we drilled down into that a little bit deeper was that these are folks, by and large, who've been with Foundation as donors for a long time. They trust us. They trust our judgment. And in some cases, people wanted to support our work in the program. They were agnostic on the subject matter of the deal. They just wanted to help us develop this new way of leveraging more capital into our community. And so they were like, well, okay, you pick the deal. We had one donor say, here's $50,000. You decide where it should go. And I think I mentioned this in an earlier story. We had first one and then several other donors who are just too busy in their careers right now to think much how they'd like to do their grant making, but they were making contributions into the donor advised fund. And so this was incredibly appealing, just like the Marin donor who didn't want assets just sitting in the fund doing nothing. And so that was perfect for that kind of a donor. I'll tell you that as of now, since September, we've had a total of $300,000 donors from their donor advised fund. We think in the foreseeable future we would be able to hit $1 million. We do have a line into some folks who we would like to be donors, who we think will become donors so that they can invest in certain deals, which is exciting. That was one of the main objectives that we had. And we actually have one in particular that requires the $50,000 minimum that I was mentioning. It's an equity fund. Just very sophisticated investors who really immediately get that this is another tool in their toolkit that would allow her to actually get a tax deduction when they make the charitable contribution, and then also participate in this particular investment. It's very exciting to us. We feel like we're well on our way, and I think a year from now this will be a full, well-established program.
Thank you. I think I'll stop here and answer a few questions.
The question that came in is we have quite a number of folks on the line that are from smaller community foundations, and they want to get a better understanding of, as a small community foundation, where do you get started, and do they sort of scope and scale of this type of work for them because of their size?
Yeah, go ahead.
Our 4 examples are all medium, large to large community foundations. They were, in fact, in the closest state of risk. It is, in fact, a little harder to figure out how to get started if you're a small community foundation, but you don't have to begin at a big scale. So most of the community foundations on this class have some funds that they use at the board's discretion as an impact investment. Even if you started with, say, $1 million, pick a nice round number, of your own money, and invested in a few things, additional tried and true areas, you would have, importantly, gone through every step that a larger program needs to go through. So in other words, there's no sparing on the steps and that you have to do to build a strong program. You would track record, which is the question that we got asked most often. Why should we believe that you can do this? Well, because we have and we can show you. So start somewhere, and starting small with your own discretionary resources is not a bad thing. And I just wanted to reiterate that I think in some communities it might be possible to donors at the very front end for them to create an evergreen fund that they actually contribute to you and belongs to you. In other words, it wouldn't recycle back to donors, so that you have some money to get started. It doesn't have to be a lot. It just has to be spent on an important, that's important to your community, and in a nonprofit or an intermediary that's viable and reliable. Taylor?
The thing I'd add to that is really start with understanding the community assets, and there are intermediaries that can support you in this initial effort. It really can help you manage a program of just $1 million to start from discretionary funds. Volunteers in the community that could support you in the underwriting of these deals to start, given our costs. Do all of deals, learn from those, and then decide if you want to create a full program that engages donors or more discretionary funds, or if you don't. But the key is getting started and doing actual investments, and then taking it from there. And as I said, you can do that with small amounts and then determine whether or not you can scale the program of sufficient size where it's self-sustaining. And I think questions have come in since we started the project on what is that size, and I think it depends on the cost and the kind of resources you need to have to execute this program. But I think a total of about $5 million is an initial starting point in terms of size that you want to get to eventually, so that you would have a self-sustaining program.
Is, are foundations doing PRI and impact investing by seeking donors and or deals only in their communities, or are there foundations seeking donors and deals nationally and globally?
Both. So I would like to take the community foundation part of that, unless you're a community foundation that's really different from mine. It is the belief that we exist to serve our local communities, and so the deals that we will do are in our local community. And that makes it very difficult to create a program because the opportunities in one community are inherently limited compared to a whole country or a whole globe. So Taylor, if you could describe the other kinds of impact investing that take a broader view, that would probably be really helpful.
There's two different types that I'll explain. The first are public charities, which have more of a national footprint and national focus. RSF Social Finance, Tides, Calvert, and they will make impact investments on a national and international basis. So they don't have the local focus. The other are community foundations that are in major urban hubs, San Francisco or New York, that have donors that have interests that expand beyond the community, and they want to see investment options that meet that interest. And we'll see them start to make investments into microfinance, into some of the clean technology and some of the other impact areas in an effort to meet the donor needs and potentially attract new donors. So it really depends on the type of foundation, the type of donor base, and the specifics of their community. But you'll see foundations kind of do both just local as well as local plus national and international impact investments.
I move on to talking about the toolkit.
So I'm just going to give a quick summary of the materials that are provided in the toolkit, and then we'll have Kathy wrap up. The first is just an overview of the program. And all of these materials are going to be provided as a Word document. You can download them and then customize them completely to your needs. So they're meant to be as usable as possible in that regard. It's an overview presentation or program overview. It's meant to describe the concept of impact investing, why this makes sense, and then the specific terms and focus areas of the program. This is the introduction to the program and is meant to be a page or two in length. sample investment policy statement that defines the objectives and the constraints of the program with some specific principles embedded in that, i.e. the use of intermediaries, the kind of risk that the program is looking to take on, and the constraints around allocations to different types of investments and specific investments. This is meant as an example, but as an interesting starting point if you're looking to create a program. Third, frequently asked questions covers general topics like what is impact investing, all the way down to very specific fun topics like what are the fees, what happens if there's a loss. Kind of the basic questions that donors will ask are all included in this document. And we call the Donor Engagement Toolkit. And this includes materials, including the team qualifications, which is something that Cincinnati found to be important as they talked about their program. And the team is not necessarily just the internal staff, but also if you are using external consultants, who they are and what kind of experience they have doing this. Sector tear sheets. So these are market materials focused on the specific program areas that you're investing. So you could have an affordable housing tear sheet, you could have an environment tear sheet, you could have an education tear sheet if you've done enough deals in those areas. Descriptions, and these are like a full-page highlight financial profile of the deal as well as all the impact associated with it. Deal sheet, so this would be just a list of all the deals that you've done. Again, financial profile and impact profile. And then the two other webinar presentations that we've provided will also be part of the packet, as well as any other resources we want to add, including the multitude of reports on the subject of impact investing.
So on the next slide, what we'd like to tell you is our pledge. By a week from Friday, also known as May 18th, all three of us listed on this slide will have for you access to the toolkit materials that has just described. Love note from us that kind of wraps the whole thing into a package. And I wanted to mention that while we will certainly provide you with a list of what we are aware of in terms of good research and reports on impact investing, there are sites that I could refer you to now if you don't happen to know them, where you could get quite material. And the first is the PI Makers Network. I'm not really sure, but they might be having their conference this week in Seattle. So you keep an eye for materials that are associated with that conference, because I know a couple of national foundations that were pretty excited about how that was shaping up. So PRI Makers Network. The second is known for shorthand as GIN, the Global Impact Investing Network, GIIN. And the third one is an organization called More for Mission. I can tell you for certain that those organizations who specialize in this subject matter already have lots of information, but we'll create, as I noted at the end of our toolkit, some things that we think are particularly useful. And close by telling you a little bit about what we sang ahead, especially a few of you asked in the question, not only what about small foundations, but what are you going to do next? Basically, it's the question. You know, where will more help come from? Well, first, I can tell you that there is a growing interest in impact investing around large banking institutions, financial institutions, and large national foundations, because it has easier for them to focus on global investing, because there are, in fact, intermediaries who can help them with that, working in those other countries. It is easy to work in American low-income communities because there are, frankly, many of them. But my way of looking at community foundations as among the smartest about what the needs are and the opportunities are in the American communities that we serve, that there is huge potential to partner with these existing foundations who don't have a way to deploy their capital effectively in the United States. to work with us. It's sufficiently of a group of organizations that I've listed here, including the White House Office of Social Innovation and Civic Participation, the Non-Finance Fund, national private foundations, including Rockefeller, who just re-upped a global impact investing program, have tended to shut it down. They decided not to do that, which I take as a great sign. Arthur Foundation, the Ford Foundation, there's a number of major national foundations who are keen to take a new look at this question. And my assessment is that there is growing interest and growing opportunity, both community foundations unto themselves in their own communities, and then possibly to connect with others, because capital into your community isn't going to get this job done. You shouldn't look only inside your own shop at resources that you already have. You should look beyond your shop and ways that you can leverage what you know and opportunities for investment with people who have capital that they either want or need to invest. I cannot promise you that there will be an organized or sustained program to provide technical assistance to community foundations, but I can promise you that I am trying like crazy to convince somebody to do that. It has been a privilege for me and the people who work at the Greater Cincinnati Foundation to benefit of a grant to support this work so far. But our job is not to keep developing this tool for the nation, but we think it's someone's job. So we are actively in conversation with other groups to try to get them to create a capacity building and technical assistance program for community foundations. And so you have that I will keep trying. And as soon as we come up with something, which I hope we will, you'll be among the first to know, because we will clearly want to be working with and through the Council on Foundations to help you know what's available.
First question for our last Q&A section for the webinar is, which are the pros and cons of the three structural options that you spoke about during the first section from a donor standpoint, and which is the most attractive and beneficial to the community foundation?
And I will say, we don't have a preferred structure coming out of this. I think it really does vary on the specific context of the foundation. I think that the more control the donor has, the more they engaged in the process, and I think this is where it led Cincinnati to do the deal-by-deal structure. I think for the foundation, the ideal is something that is more commingled from an administrative and execution perspective. It just makes it a lot easier. I think the key is finding the right balancing act between those two needs. And our recommendation is to find a way to create a pool, but then give the sense of customization to the donor so they feel like they're targeting the specific things that they're interested in. Kathy, that?
Our question is, as there's a growing demand for investors and donors and foundations for impact investing, there's also the need for companies that are getting bounced back and forth between traditional investors and funders. What are the ways for companies and CEOs of companies to access these types of not just impact resources, but also PRI resources?
And I would say this is a unique market, and companies I think have to some extent struggled to tap into it. It's not quite as big as you believe through the press, and it's harder to access because it's so unique to the investor. I mean, what they care about is what they care about, and the business needs to kind of fit into that. And working through a community foundation, building a relationship with the person in charge of developing the pipeline is the key step in getting eyes on their opportunity, and ensuring that the business is locally focused, has the mission impact component to it, and that's clearly articulated to the foundation, because that is the first and primary lens by which an investment will be evaluated. and then the financial lens comes as a second consideration as part of that. So a clear around why a community foundation should invest in them, what they're doing in the community that has community impact, and really how they're going to be able to repay a loan or exit from an equity investment for the foundation is really the second step.
Say, if I understand the question correctly, that we have made a specific decision that we will not at this stage in our development invest directly in an individual for-profit company. We do that through intermediaries, and we have them, and we have to build their capacity so they can be better at helping individual companies. But in our that's for startup businesses, seed capital for startup businesses, the IT, advanced manufacturing, and industries. Tour companies are listed, but none of them directly by the community foundation. In other words, our money is packaged together with them. The same thing will be true of the business accelerator. We will not lend directly to an individual company, but rather the MBA, as we call it for short, will serve as the intermediary to relate to those companies. It is in fact something that's done. Your question suggests that it's done with great difficulty, and I can appreciate that. But the larger impact investors like big banks and CDFIs and perhaps some private foundations are better equipped to do work than community foundations are, in my opinion, at least at an early stage.
And on that, I mean, I think it's really important that you clearly articulate what the community foundation will and won't invest in. I think a question that we got earlier is has issues of being inundated with requests for funding once they knew this pot of money existed. And I think the way to negate that is to ensure that it's clearly communicated on your materials, on your website, in general relationships that not in Cincinnati's example in a direct operating companies, and that will help kind of take that off their plate.
And a question for today is, given these types of investments, what happens during sort of a default or a blow up, and what are sort of the ranges of returns and debt parameters you guys have seen?
Tell the win story.
There are they're going to blow up at some point in a portfolio. You're going to run into issues, and it needs to go to distress mode whereby you take the underwriting resources. So the resources you've been applying to perform due diligence on the deals, and you're now redirecting those to work through the deal with the objective of getting your capital back. Restructuring the loan, if it is a loan, through working with the management team to make the necessary changes to kind of get through the difficult period that they're facing. With that, you could have a loss of principal. You could have a negative return on that particular deal. And this is where, particularly if you're offering a pool, you have a range of deals. You have diversification across deals, and that loss will be offsetted by returns from other deals. Mentioned earlier, the types of returns on debt, is kind of 1% to 5%. Equity, you would expect to get, higher returns, although as you're looking at transactions that are getting you below market rate returns, so relative to what you could get in the market if you didn't have the same kind of impact and local community constraints.
Particular deal, because the litmus test of our committee was whether or not we would actually make an organization headed by a nun repay if it was going to put the organization out of business if the deal went sour.
Right.
Basically, we had to say, you know what, and let it get to that point. We would go into the exact mode that Taylor just described, but if push came to shove, yes, in the meantime, we put in place enough risk mitigants and enough loss action that we think that won't happen, but that takes a while to work out and is a key part of the due diligence process.
Great. Thank you, everyone, for joining us today. The contact information for Kathy, Taylor, and myself is on your screen. It will also be emailed to all of you through our follow-up email. What you'll be receiving coming up is either when you close out of the webinar, you'll be provided a survey for the evaluation of this webinar. So please fill it. If you don't have time right now, you'll be receiving a follow-up email by tomorrow morning so that you can fill it out as well. In addition, today's webinar has been recorded and will be emailed to you as a follow-up email and will also be available on our website. Please don't forget the registration is officially open for Conference for Community Foundations, which will be scheduled September 10th to the 12th. So we are very, very excited to have all of you join us there. In addition, our upcoming webinars is Becoming a Web 2.0 Philanthropy. It is indeed a free webinar on May 17th. And supporting nonprofit capacity building, considering multiple strategies to further mission on May 30th. Again, we also have Sizing Up Strategies for Staffing Emerging Community Foundations on June 20th, and Board Engaging the Full Potential of Community Foundation Directors on August 8th. In addition, we have a CCFA Public Policy course taking place in Jackson, Mississippi on June 4th. So we hope that you will join us for as many of these events as you can. Thanks to everyone for joining us today, and thank you, Kathy and Taylor, for all of your amazing insight and hard work in this area.
Very much for hosting.
Thank you.